Good evening, everyone, or good afternoon, depending on where you're at across the country. My name is Jason Maida. I'm going to be your host for our first Georgia Tech Homebuyer Workshop. I know everybody's starting to get into the Zoom class here, so we're going to allow everybody to join in just over the next couple of minutes, and then we'll get started in tonight's or today's content. We really appreciate you joining tonight's class. Again, this is our first class with Georgia Tech. We're excited to offer this content to our first-time homebuyers. We get a chance to teach this information all across the country to various alumni partnerships we have, including Georgia Tech, and you're going to learn a little bit more about that in just a bit. Tonight's class is a very kind of interactive session. So as I go through tonight's slides, we would encourage you to answer or ask questions. We'll answer those live on air for you. You can just use the chat function in Zoom, and then we'll go ahead and answer those questions as we roll through tonight's presentation. So it's just about a minute after the hour. So we have quite a few people signed up for tonight's class. So let me allow them to get into the Zoom, and then we'll get going. So I'm going to go off camera. I'll jump back in, and then we'll get tonight's class started. All right, we have a few more guests hopping into the class, so we're going to allow them to get settled in. In case you missed it, just a few minutes ago, I mentioned my name is Jason Maida. I'm going to be your presenter tonight. Really excited to bring to you our first Georgia Tech class for our alumni partnership with Georgia Tech. Just as a reminder, this is a very interactive session. So as we roll through tonight's content, really encourage you to ask questions of us. We'll do our best to answer all those questions on air. We are going to record tonight's class as well as share back with you all of tonight's presentation material. So in case you missed something or want to maybe share some of this information with friends, family, maybe even a coworker, you'll have all of tonight's content to go ahead and pass along to them or to refer back later. Since this is a class focused really for Georgia Tech, I know we have alumni across the country. So just so I can kind of get a sense of where everybody's at in the country, and we'll kind of do this on the fly. If you can, maybe just put in the chat, like where you reside or maybe where you think you want to purchase, because that'll kind of help us maybe answer some of the questions or maybe tailor some of tonight's conversation around kind of what areas of the country you might consider. All right, we got somebody from Boston. All right, that's awesome. So we'll talk a little bit about that. The ETL, okay, cool. We got some coming in. We got Arizona. Okay, awesome. We got Salt Lake. Okay, gosh, everybody's everywhere. Okay, this is exciting. So yeah, we got a lot of different responses. We got San Jose. So we got everybody's everywhere. So this is good. And that's actually the first time I've kind of asked for a kind of a poll from the audience just to see where everybody's at, because I may talk a lot about Georgia, for example, and that might help one of our classmates here in the ATL, but if you're in San Jose, it's going to look completely different, right? So it's good to hear kind of where everybody's at. All right, well, thanks for sharing that. I know we got more chats coming in here. We'll go ahead and I got a good sense of where everybody's at across the country. So it looks like we have a little East Coast representation, a little bit kind of sort of Midwest, and then of course we got the West Coast and the Southern states as well. So again, thank you so much for joining tonight's class. This is our first Georgia Tech Homebuyer Workshop. And, I know everybody has a busy week. It's a Wednesday night. You probably have other things that you probably would rather do than talk about finances. But, the fact that each of you have taken the time out to just maybe learn a little bit more about how you can start this path to home ownership means a lot, right? So this class will run about an hour. So it'll take us right about to the top of the hour. We'll go ahead and interweave in that, quick Q&A along with some of this helpful content that we share with you. Just a little bit about me. As your presenter tonight, I am a branch manager with American Pacific Mortgage, and I get a chance to facilitate classes like this all across the country. Something I love to do. I'm really passionate about homeownership and supporting first-time buyers in that journey towards homeownership, because this is probably going to be one of the biggest investments you decide to make in your upcoming financial futures. So, I know you can Google a lot of things, but I think having, someone that can teach you and help you understand all the tools and resources and the workflow of buying a house, I think is super important. So let's talk about some of our talking points for tonight. So we're going to spend some time looking at the housing market in just a bit. Lots of news to kind of talk about there, especially around interest rates too. So we're going to look at, where are interest rates at today? Where are some of our projections of where those are going to go? Because those will influence probably our timeline of buying, what we can buy, all of that. We're going to spend some time looking at budgeting in just a minute. So I'm going to walk you through a rent versus buying calculator, talk about credit. We'll then look at some student loans and maybe can student loans impact our qualifying. We'll talk about loan programs. We'll also look at some of the documentation we generally need when we decide to take the next steps in homeownership. We'll also spend some time looking at first-time home buyer programs. There is first-time buyer programs all across the state, so I know we got a well-represented audience of different markets. We're going to talk about the Georgia first-time buyer program, but there is very similar programs all across the country, and we can take some of that conversation offline. And then we'll wrap up tonight's discussion looking at the workflow of buying a house. So if I'm kind of excited about what I'm hearing tonight, what are the next steps I should probably think about doing in preparing to purchase a home and hopefully get to that finish line of owning a home? All right. So as I mentioned earlier, buying a house is probably one of the biggest decisions you make in your upcoming financial future. So taking time out on your busy Wednesday night is a big step in the right direction. A lot of cool benefits that come along with owning a home too, right? So if we think about owning a home, not only do we have ownership, but the ability to be able to have something that controls our affordability with owning a home, meaning our budget, so we don't have to worry about our rent going up each year. This is an asset, so assets hopefully will appreciate over time. So the difference in what I owe on my house versus what the market value is, that's called equity. The more equity we have, the more wealth that gets created. This is an asset that you could potentially pass along to maybe the heirs of your estate, dependents, partners, and there's some really great tax benefits that still come along with owning a home. And so as we get launched into tonight's class, let's first of all kind of start that launch with kind of looking at a rent versus buying calculator, because I think starting to consider home ownership really starts with really getting a good understanding of your budget, because home ownership can work for a lot of our students that attend our classes, but the timing doesn't always work. So I think if you can start with a good solid budget, that can help and aid you on this path towards home ownership. So this first calculator we're going to take a look at is a rent versus buying calculator. In case you didn't hear earlier, all of our tools and resources that I reviewed tonight, I'm going to send back out to you tomorrow morning. So you'll get that from Ken on our team. And so you can kind of check out these calculators on your own. But let me just walk you through kind of an example of what this might look like for you in thinking about purchasing a home. So as we build this scenario, we just kind of put in a what if scenario on the rent versus buying calculator. This is on the Freddie Mac website. You're going to learn a little bit more about Freddie Mac in just a bit. So let's assume we have a scenario where we're paying $2,000 a month in rent, right? We have monthly renter's insurance of $15. We're going to assume that our rent will go up about 5% every year while I'm renting. Okay. So we're kind of doing a forecast of what rent could look like. And then if I open up my home purchase tab, let's assume I'm going to buy a house for $400,000. I know that purchase price looks different for someone that's joining us here in San Jose tonight, or someone that's going to join us maybe in Boston or Phoenix, wherever the case may be. So those prices differ. That's why I would encourage all of you, take a look at this calculator when you have time, run your own calculus and see what kind of that comes back for you. But ultimately, we're going to plug in 400,000 for tonight's conversation. Minimum down payment, 3%. We have estimated property taxes of $5,000. Taxes will vary depending on where you're buying in the country. So taxes could be a little higher in Texas than maybe say they would be in California, or vice versa, right? We have homeowners insurance. So that's going to insure that our home against any perils like maybe burglary or fire, flood. Even in California, there's earthquake coverage, right? We have maintenance costs that we want to plug into our budget. And then we have loan information. So when we think about our loan, generally as a first-time buyer, it's going to be a 30-year fixed mortgage. I'm pleased to say that rates have kind of scaled down to like 7.1% today. We're going to talk about rates in just a bit, kind of what's driving some of that change. We have origination costs. That's the cost that you're going to pay for your financing options. Now, let me just kind of make a quick note here. So as part of our Georgia Tech partnership, as well as some of our other partnerships across the country, we go ahead and reduce down our cost to help better support our alumni. So we actually reduced our cost by $750 on the origination side. And then there's discount points where you can have the opportunity to lower your interest rate by paying more funds out of pocket. That's called discount points. Usually one discount point is the equivalent of 1% of your loan amount. So if I decide to finance $390,000, my discount point would be $3,900. And generally 1 point will drop your interest rate about 0.25%, okay? We have other settlement services. Those are going to be what we call as closing costs. So those could be attorney fees, title and escrow fees, maybe some transfer charges that are represented in that particular county, maybe taxes. Generally, we would recommend the total closing cost between what you have in lender costs, your county charges, attorney charges, all of that generally to be around 2 to 3% of your sales price. So when we think about savings, we want to save for not only our down payment, but we also need to save for what we call as closing costs. All right. Now, the last tab is other assumptions. So we want to assume that our home is going to go up, let's just say 4% on an annualized basis. Right now, some of our early projections for home prices next year in 2024 that they could rise as high as 5%. So, we're kind of going a little bit more conservative here. We expect that we're going to be in our home for 7 years. The selling costs of our home. So what we're going to do in this analysis is say, if I buy today, but I sell 7 years from now, what that's going to look like at the end of 7 years. And so the cost of selling my home and paying for realtors that are involved in my sale, as well as closing costs as a seller, we're going to just forecast at 10%. We have our state and federal tax rate, and then we have the savings rate. So what this calculator does is it says, okay, now, I know if I decide to purchase, my payment's going to be significantly higher than what I'm renting at right now, right? So I know I'm paying $2,000 a month. If I decide to buy in today's market, I'm at about $3,500 a month. So a $1,500 jump in my expenses. So I have to prepare myself for that. Now, the trade-off for that is that I have an opportunity that over 7 years by buying instead of renting, I have about a $43,000 opportunity. And how I arrive at that number is by the appreciation of my home and the potential tax benefits of owning my home, and then not having to worry about, my rent continuing to increase over the next 7 years. So that's one approach that we kind of take into consideration when we look at buying options for our clients. I would encourage you, try to do the same or do a scenario for yourself when you have some time. And again, we'll send all this material over to you tomorrow morning. All right. That's our Freddie Mac rent versus buying calculator. All right, now let's talk a little bit about the housing market. And so at this time of year, seasonally, we see home prices maybe dip a little bit, buying activity to kind of slow down a bit. And, we have similar challenges across all markets in California. So whether you're in Arizona or Boston or Georgia, wherever the case may be, there really isn't a lot of inventory out there for buyers to choose from. Now, the encouraging sign is inventory is starting to pick up a little bit. And the reason I say that is because a lot of sellers that are kind of trapped in their 2.5 or 2.6% interest rates that they got back in the middle of the pandemic when they refinanced are now having to make some tougher decisions on, hey, I still really need to sell. I really want to buy that next house, or I'm ready for retirement. I really want to move out of California and I want to go to Arizona, whatever the case may be. Sellers are having to make decisions now. And so I think we're starting to see a little more inventory pick up, which is encouraging for our buyers. Also, new construction is picking up a little bit. So those are all encouraging signs. So buyers have more choices. And when we look at the specific kind of housing data here in Georgia, kind of shows you a little bit of a decrease here in average sales price right now at 409, coming down a little bit. Some of that's kind of seasonal. But we are expecting potentially a 5% increase in home prices into 2024. Now, what's going to drive that increase? Well, we're still thinking we may have some inventory challenges in 2024, but we're also forecasting interest rates to come down a bit in 2024, which will add to more buyer activity out there. And so, the old supply and demand, right? We still have high demand, we have limited supply. It will probably still push prices up into 2024. We probably won't see any significant interest rate relief until we get into 2025. But it's interesting when I do the analysis, and I share this with existing clients, is that if I was to buy today in 2023 versus buy in 2024 with expected home prices going up 5%, right? So if I do the comparison and say, if I buy today at 7.1 or 7.25 versus buying at 6.75 in 2024 with higher prices, the payments, ironically enough, are actually about the same. So in my mind, as we're coaching clients, is that I would much rather purchase at a lower price level. So that $400,000 house in today's market versus the $420,000 market in the 2024 projections, because ultimately clients that are purchasing homes today are probably not keeping that financing long term. They're probably looking at refinancing sometime down the road. So it's really more about the entry point into the housing market. If it works for you, if the sales price is gonna be a solution that can work for you, and of course today's interest rates that lead to your monthly budget. So when we look at interest rates, we love to see this, right? This blue line represents the 30-year fixed mortgage. Of course, interest rates going back into the pandemic, we saw interest rates at the 2.625 level, which was just not something that we've ever seen at all in our interest rate market. We did hit 20-year highs in interest rates just 3 weeks ago, which is kind of just mind-blowing. But the turn of events has been in the recent week and a half, where we've seen interest rates go from 8% almost to now we've almost got down to 7.25, 7.1. What's leading to that? Well, we're seeing some cooler inflation numbers. So a lot of what's driven up interest rates has been what the activity the Federal Reserve has taken to combat inflation. Well, now we're seeing inflation numbers cool. The Federal Reserve has kind of pulled back a little bit on the interest rate hikes. And for all intents and purposes, most of us in the market believe the Federal Reserve is done increasing interest rates. So we've kind of reached the peak. At least that's what we're hoping. And so that really is a great sign for future home buyers. Now, when we think about interest rates and what goes into an interest rate, it's not the same for every client. And I think that's really important to understand, because there's various characteristics that make up interest rate. That includes what your credit eligibility looks like, what the type of product is that you're selecting, how much you decide to finance, what your down payment looks like. And we talked a little bit about it earlier, which is if you decide to buy discount points, that can also bring down your interest rate. And the last characteristic is term of your loan. So generally in a normalized market, if I go from a 30-year loan down to a 15-year loan, that's going to improve my interest rate options. But in today's market, believe it or not, we're not in a normal market. So we currently have what we call an inverted yield curve happening in today's market, where 30-year fixed and 15-year fixed are almost identical, really. As we meet with clients, we design home buying plans. We try to figure out what's the right product and interest rate option for us. So if you decide to take those next steps in home ownership and allow us to help you design a home buying plan, we'll kind of talk more through interest rates and see what the best solution is for you. Well, one of those characteristics in interest rates is credit. And when I consult with clients across the country, there's usually kind of two, I don't want to say challenges, but maybe challenges or opportunities maybe in building a home buying plan. It could be around credit, because maybe I'm a little bit overextended or I have some past challenges in my credit, or it could be savings for my down payment. We're going to talk about savings just a little bit later, but let's dive into credit and talk a little bit about maybe ways that we can help improve our credit score. And I think it's helpful to first understand what goes into the score calculation. Now, many of our clients that we work with have various tools that they have at their disposal, like Credit Karma or TransUnion, Experian, Equifax, all their tools that they offer. But let's take a look at the weighting of a score calculation. So 15% of that's going to be how long have I had credit? So the more mature my credit file is, the better my credit score can be. 20% is going to be how much new credit am I trying to access? So did I open a bunch of accounts? How many inquiries have I had on my credit? And when we think about inquiries that are going to impact your score, we're looking at more hard inquiries. So when we start our process in designing home buying plans for our clients, we only start with a soft credit score because we don't want to create that impact to your score. And because many of our first-time buyers aren't ready to purchase right out the gates, right? It's a kind of a process, whether we're trying to buy in 24 or 25, it's something where we don't want to impact our client's credit score. So we always start with a soft credit score. 30% is going to be around revolving accounts for credit utilization. So when we're thinking about that, we're looking at our total credit limits versus our credit balances. So if I have, let's say, $10,000 in credit limits, I have $5,000 in outstanding balances, I'm going to be at 50% utilization of credit. And the rule of thumb or the optimal level is I really want to get my utilization of credit below 10% or at or below 10% utilization. So if I've kind of charged up some debts recently because I booked a vacation or I'm planning for the holidays and I'm at 70 or 80% utilization, we'd encourage you to try to first get that down below 50% utilization. And then once we've got there, we feel pretty good about it, then let's get to 10% utilization. The last component of score calculation is how have I paid my bills, right? And that's pretty simple. If I've had some recent delinquencies, late payments, they're going to be categorized as 30-day lates, 60-day lates, and then 90-day delinquencies. So the more severe my delinquency, the bigger impact I'm going to have to my credit score. When you've had events like late payments or maybe even a hard inquiry, they're going to most impact you in the most recent 1 to 2 years from the date of the event. Okay, so if I have quite a few late payments just recently in the last 6 months, those are going to be a bigger impact to my credit score than, let's say, delinquencies I had 5 years ago, right? Now, every loan program is going to have a minimum credit score. So whether I'm doing an FHA loan, a conventional loan, maybe even for some of our veterans that are looking at the VA product, there is a minimum credit score, as you can see on screen, for each one of those products. Let's talk a little bit more about some other score factors to kind of take into consideration with credit. So if I've had kind of major events like a bankruptcy or a short sale, maybe a foreclosure, those are going to have a larger impact to my credit score, especially, like I said earlier, within the most recent 1 to 2 years from the date of the event. Now, we talked a little bit about credit utilization. Now, let me give you a quick tip on how to manage utilization and how the creditors send out data to the agencies. So if you were to take some time tonight or tomorrow and look at one of your credit card statements, on that statement, you have a billing cycle date, and then you have a due date, right? The due date is when you have to make your payment, and you generally don't want to go past that due date because you have a late charge. Now, the billing cycle date is when the creditor sends out all of your account data out to the agencies. And, if you've recently charged some stuff up, that higher balance, even though you intend to pay it off on your due date, will be reflected on your credit report. So my kind of tip for you guys tonight would be, is if you can try to pay down that credit balance before the end of the billing cycle date, you're going to have lower utilization. And with that lower utilization, achieve a better credit score. Okay. So that's kind of a little bit different way of managing your credit cards. So instead of due date, try to manage to your billing cycle date. All right, and then account closure can impact your score. And what I mean by that is when you decide to close out a revolving account, it can at times negatively impact you, especially if you don't have a lot of credit cards active. And what happens when you close out an account is you actually strip away of all the history of that account from the credit model. So if I've had an account for 10 years and I decide to maybe close out that account, once I've closed out that account, all the history for the last 10 years gets kind of stripped away from the credit model and could potentially sink my credit score. So we want to be very careful that we don't, close out accounts that are really long established mature accounts. And when we think about lending, we always look at all 3 agency credit scores. So TransUnion, Equifax, and Experian. So if my scores look like this, if I'm at 760, 740, 720, we'll use the 740, which is we call the middle score for qualifying purposes. Now, if I do want to add a partner to my loan and my partner is going to help me jointly qualify, if they're at 720, 700, and 680, now my partner has a lower middle score. So in that scenario, we would have to go off of the 700 credit score for my partner versus using my score. Okay, so it's always the lowest middle score between both borrowers. So this is a matrix that kind of shows you how long negative items will remain on your credit. So those hard inquiries, while they'll impact you in the first 1 to 2 years, this is how long they'll be on your credit report, late payments, federal debts, things like that. So just something kind of keep in mind. Now, student loans are something that our clients have to deal with. I do understand federal debts have started repayment just last month. So many of you might start those payments. And there's different ways that we approach looking at student loans from a qualifying perspective. So now that student loans are in repayment, most balances are now reporting the minimum payment, but at times they don't necessarily show on credit reports. So here's our approach on the lending side. So if you're in an income-based repayment amount, then we can actually use that payment amount for the payment to qualify you for your mortgage. So if you set up an income-based repayment amount, let's say you owe $75,000 in debt and your income base is $250,000, that's what we'll use for qualifying purposes. Now, if you have not set up a repayment and maybe you're back in school, or maybe you're on forbearance for whatever reason, as a default number, we have to take 1% of the aggregate balances for a Fannie Mae or Freddie Mac conventional loan. On an FHA loan, we take 0.5% of the aggregate balances, and that's how we establish their payment. So it's better for our clients to be in an income-based repayment amount because generally that amount is significantly lower than what we would use for financing. Okay. So again, if you're back in school and you're not doing an active repayment, even though you're back in school, we still have to count a minimum payment for you for qualifying purposes if you're looking to qualify for a mortgage. Okay. Any questions on, I know I kind of went through some of this stuff pretty quick, but any questions so far on student loans, credit, any of the things we've kind of talked about so far? Okay. All right. Again, if you have some questions on tonight's material, don't hesitate to drop the question in the chat. I'll answer that on air for the rest of our audience. Let's talk a little bit about loan programs. Oh, and just as I get in there, let's see. Okay, so we're all good. So let's talk about loan programs. And there's 5 core programs that we generally talk about in our classes. And so I'm going to spend some time kind of diving into each one of those products and some of their characteristics. You've probably heard of them, especially if you're starting to do some research on your own. And the first one we'll start with is a conventional loan. So when we think about a conventional loan, that's going to be for a Fannie Mae, Freddie Mac loan. Generally speaking, the minimum down payment is 3% for a conventional loan, as long as I'm not going to finance more than $726,200. Now, for some of us that are in higher cost of living markets, so for those of you in California, I think Boston, I think has a high cost of living area too as well. You have the option to go beyond $726,200. It's what we call as high balance. But when we do that, that also elevates the minimum down payment from 3% to 5%. Okay. So that is for what we call a high balance loan, but the baseline number is a minimum down payment of 3%. So for those of us joining in ATL, the maximum loan amount would be $726,200 with that 3% down payment. FHA loans are going to be for our clients that not necessarily are first-time buyers. You could be a second or third-time buyer. FHA stands for Federal Housing Administration, so it's a federally insured mortgage. Has a minimum down payment of 3.5%. So whether I'm going to go up to the conforming limit or I'm going to go up to higher cost of living areas or purchase the higher cost living market, I still have a minimum down payment of 3.5%. As you can see on screen, this is specific for Georgia, but the maximum loan amount in Georgia for a FHA insured loan is $592,250. FHA is going to add a little bit more flexibility from a qualifying perspective. If you recall earlier, minimum credit score is 580 on FHA versus conventional is a 620. Now, for our veterans that have served and have VA eligibility, we have the VA product. One of the cool benefits about a VA product, it has a 0 down payment option. If any of our veterans have any partial disability from serving, there's a funding fee on VA loans that get completely waived with that benefit. And the VA product has the option to go up to $1 million or even more with no minimum down payment. So great product to help support our veterans in home ownership. And then the USDA product is going to be an option where if you really want to purchase in like a rural area in the country, USDA will support us with financing resources there. USDA is a 0 down payment option. And there's 2 kind of big qualifiers with USDA. It's about the location of where the property is located. So I have to be in a rural considered area. And they're going to look at our income as a household. And so we have to be below a certain threshold when it comes to the income for that particular product. And then the last product, which isn't really popular, isn't common with our first time buyers. It's called a jumbo loan. So if I need to stretch beyond what maybe a conventional loan or FHA loan can offer, because I need more bandwidth from a financing perspective, I can do a jumbo loan. It's for clients that need to buy over the conforming limit, or maybe if I'm in San Jose and I need more financing than $1,089,300, I would turn to a jumbo loan. The jumbo loans have higher down payment amounts. It's usually 10 to 15% down payment. So we're thinking about more assets that we need to kind of put together. It also will have what we call as a reserve requirement, where we need some additional assets that we set aside in addition to my down payment and my closing costs. Usually the reserve requirement is the equivalent of 12 months of your monthly payment. So if I have an $8,000 mortgage payment times 12, that means I need like an additional $96,000 in assets. Okay. Now, when you purchase a home and you put less than 20% down, there's a thing called mortgage insurance. And I know many of you have probably heard about mortgage insurance. And I think there's a lot of misconceptions around mortgage insurance. So when we do our classes across the country, I always like to kind of dive into mortgage insurance, dispel some of those myths, because when we think about affordability for our first-time buyers, mortgage insurance plays a pretty large role in that. Not just interest rates, but we also want to look at mortgage insurance. So there's different payment options for mortgage insurance, specifically to a conventional loan. You can pay it on a monthly basis, which 95% of most clients do that. You can split the MI up, where you pay some of it up front, some of it in your monthly payment. You can do a single premium, where you're in essence buying out the total mortgage insurance for the life of the loan. And then you have lender paid mortgage insurance, and that's where you elect to take a higher interest rate. So instead of maybe a 7.25 rate, I take an 8% rate, and that buys out the mortgage insurance completely. As you can imagine, in today's kind of high interest rate market, buyers aren't generally doing that fourth option. It's usually the monthly MI. And the reason why is because monthly mortgage insurance has a potential cancellation option. So when I reach at least 2 years in my home and I have 20 to 22% equity, I can apply to have that mortgage insurance canceled. All right. When we look at the different or characteristics that go into PMI, and this is kind of where there's a little bit of a misconception out there, there's different characteristics that go into the calculation for mortgage insurance. It takes into consideration your credit score, how much I'm going to put down for down payment, and what I decide to finance. Those all get factored into the mortgage insurance premium. And why that's important to understand is because if you're doing some searches on Redfin or Zillow and you happen to use their calculators are not going to be set up to kind of specify those characteristics. It's kind of a one size fits all situation. But in reality, when you look at a PMI example, which we have on screen here, if you took a $450,000 house, or I'm sorry, amount financed, you put 3% down and you had an average score of 740, you're probably looking at only 100, I shouldn't say only, but $183 a month. Whereas if you run that same calculation through Zillow or Redfin, it probably comes back at $300 or $400 a month. So when we think about affordability for our clients and designing home buying options, obviously mortgage insurance is something we're going to talk about. Now with FHA loans, it's a little bit different because FHA, as I mentioned earlier, has a little more leniency from a qualifying perspective, lower credit scores. It'll kind of look past some challenges that we've had with maybe late payments or maybe just some disruptions in our overall credit. Now, the payment options on FHA, there's two PMI options, or I shouldn't say two PMI components. There's monthly mortgage insurance, which is 0.55% of my loan amount. And there's upfront mortgage insurance, which is 1.75% of my loan amount. Now that 1.75% gets added into my total amount financed, but it does increase our borrowing nonetheless. Now, FHA mortgage insurance has no cancellation option. So the only way I can exit mortgage insurance with FHA is if I decide to refinance maybe into a conventional product down the road. Okay. Now let's look at an FHA PMI example. And FHA has recently decreased their PMI costs. I shouldn't say recently, over the last 3 months, they've decreased the costs. Let's look at the same example of, let's say, a $450,000 loan amount. So you can see that on screen. My upfront mortgage insurance, that 1.75% would be $78.75. So now I have to add on $78.75 into that 450 number. So now I'm financing $457,875 on an FHA loan. And then my mortgage insurance on a monthly basis is $206.25. So a little bit higher than conventional loan, but of course we have the upfront mortgage insurance that gets added on. So again, this product is another option for clients. It allows clients to achieve homeownership that maybe would have some challenges otherwise. And so as we meet with clients to design home buying options, we're going to help you kind of figure out what's the best solution based upon some of your home buying goals. Okay, so let's talk about, the documentation that you generally need in taking the next steps to home ownership. So if I'm currently working for a W-2 employer, it's pretty simple. I'm just going to need the last 2 years of my W-2s, usually 30 days of pay stubs. And then through our processing of your loan, we're going to verify your employment. That generally happens after you have an accepted offer with a seller. Now, if I'm self-employed, it's a little bit more document intensive because I will need to have at least 2 years of tax returns. The business does have to be in existence for 2 years. We'll need probably a balance sheet, a profit and loss statement, and then we'll have to verify the health of the business through like a CPA letter. Okay, so that's kind of just the basic documentation. Let's talk about, what's used or what we look at from a qualifying perspective when it comes to income, because there's also some misrepresentations of what's needed for a buyer when it comes to purchasing a home from an employment perspective. So first of all, the rule is you do have to have at least 2 years of employment and or education. So if I just finished up at Georgia Tech in the spring and I started a new job just here in the fall, now that I have 4 years finished with Georgia Tech and I just started my job, that would make the minimum qualifying of the 2 years. Okay. I don't necessarily have to be on my job for 2 years. I just have to show that I have education and or career to support the 2 years. Now, where it gets a little different is if I have dual employment. So if I have one job that I've been working with for, or I work, I should say, 30 hours a week with, and I have another job for 20 hours of work, then I have to show that I've been on both jobs simultaneously for 2 years, because we want to show that you can demonstrate that you can work two jobs at once, right? So that generally we see that sometimes in the healthcare industry. If I am like working a 40-hour work week job, but on the weekends I like to drive for Uber and I want to consider that income for qualifying, then I have to show that I've been basically doing both simultaneously for 2 years. So I have to work my 40-hour work week job for 2 years, as well as drive for Uber for 2 years. Okay. So that's where it gets a little bit tricky. Now, if I have a new job, so if I'm currently working right now, but I'm deciding on taking a new job, but I'm in the middle of kind of getting ready to qualify for my mortgage, can I use my new job? And the answer is yes. If I have an executed offer letter, then we can factor that into the new income qualifying. Okay. And then last, I'm going to answer some questions in the chat in just a second. Last thing I want to just comment in on income is if you have additional income, either through boarder income, or you have somebody that's renting a room, or you have a partner that doesn't want to be part of the financing, but you want to include their income, only income derived from borrowers can be used into the qualifying. Okay. Now, in some cases where you're going to buy maybe a multi-family property where it's a multi-unit, so it's maybe 2 units, and you're going to rent out 1 unit of the property, potentially in some programs, you can use that projected income for qualifying, but not for existing, maybe for a place that you're renting right now. Okay. All right. I missed some questions in the chat. So let me just, so question was, are all these programs that I just went through, are they all only just for first-time buyers? So the answer is no. So the minimum down payment on a conventional loan is 3% for first-time buyers. If you're a second-time buyer, it's 5% as a minimum down payment. Let me give you a quick definition of first-time buyer, because that might change, kind of how you guys are thinking about this. So a first-time buyer is someone that has not owned a primary residence in the last 3 years. So I may have a rental property in Phoenix, but I've been living in a different place for the last 3 years. Well, guess what? I'm still considered a first-time buyer because I haven't lived in that property consistently for the last 3 years. Okay. Another question was, would you consider upfront PMI part of closing costs, or would you need to budget for that separately? So upfront PMI is included in our total amount financed on an FHA loan. So it won't show up. It's a cost, but it's not an out-of-pocket expense because it's getting rolled into your total amount financed. All right. Great questions. Appreciate that. And feel free, if you guys have other questions, just drop them in the chat. We'll get those answered for you. Let's stay with income for just a little bit longer. And that is around a calculation that us as lenders use to determine qualifying. It's called debt to income ratio. What debt to income ratio does is it takes your gross monthly income versus your monthly expenses. And it tells us, what is being allocated out of your income towards those expenses. It's a really simple calculation because we're looking at your pre-tax income versus things that will appear on your credit report, like existing credit card debt, personal loans, student loans. We'll also factor in the new housing budget as well too. We generally don't want your expenses to exceed more than 43 to 45% of your pre-tax income. Now that's from a qualifying perspective, but one of the things when we design home buying plans for our clients is that we're going to look into is affordability. Affordability is super important. And that's a conversation we have with you one-on-one during a consultation, because even though you can qualify at a 45% debt to income ratio, it doesn't necessarily mean that you should be buying at that level. And that's, like I said, a conversation we can have as we design home buying plans for you. So here's the formula, pretty simple: principal and interest of the loan, the taxes on my new house, the insurance on my new house, PMI for my house. So if I'm going to put less than 20% down, if I decide to buy maybe a townhouse or a condo, I probably have homeowners association dues, expected, expected debts like auto loans, personal loans. All of that will be factored in there, which in this scenario, we have $500 a month. And then we took our borrower's gross monthly income of $8,500 a month. So if I take the 3,000 divided by 8,500, I come up with a debt to income ratio of about 35.29%. Now, that's a really good debt to income ratio for most of our clients, because most of our buyers feel good around 33 to 36%. But at times, some clients feel okay at 45%. And that's something we can certainly look at. It just depends on kind of where you want to land from a monthly budget perspective, because we're really passionate about affordability for our clients and sustainability, right? We want to make sure over a long period of time that our buyers can afford the home that they're purchasing. All right, so the last kind of ingredient, if you will, to thinking about home buying is my assets or my savings, right? So, that is that second challenge that some of our buyers have, is like, how do I save up enough money? I'm in a high, expense, environment right now. Inflation's super high. I pay a lot of rent. I got student loans. How do I save to purchase my home? And that is a real challenge, right? And so, there's things that we can kind of help you with from a savings and budgeting perspective that we can do during a consultation. In terms of the financing side of things, this is kind of the documentation that we'll generally need when you're looking at kind of showing what assets you have to purchase your home. So checking and savings accounts usually captured in the last 60 days. Cash deposits can't be used for sourcing of funds. It has to be all we call seasoned funds for 60 days. Sometimes you can use your retirement accounts, 401ks, 403bs, IRAs at times. We would encourage you to talk to a financial advisor, because those don't always make sense to tap into, especially if you create a tax event for yourself. At times, some clients will use what we call as gift funds to purchase their home. So that's where a family member has helped contribute funds for the home purchase. And those funds don't have to be seasoned. That's where a family member is saying, hey, I would love to help you out with, say, $10,000 towards your home purchase. We document that generally through a gift letter, and then we kind of document how those funds are transferred. Okay. Now, with our savings, I said, just a second ago, it's usually kind of the challenge of buying. And as we launched in tonight's class, I mentioned to you that most states, or almost all states across the country, have first-time buyer programs that are available to you. A lot of people don't know that, but there's what we call as HFAs generally set up in every state. And they're called housing finance agencies, designed to support low to moderate income home ownership. We're going to talk about the Georgia programs right now, but I know we have an audience all across the country. So maybe offline, if you do have some questions about, first-time buyer programs like in Arizona, for example, we can talk through that with you and see what programs might best support you, because we understand the challenges of home ownership. Not only is it just things are more expensive, but just trying to be able to create enough savings to buy a house can be one of those kind of hurdles that you're trying to overcome. So specifically in Georgia, there's the Georgia Dream Home Ownership Program. And it's, again, supporting low to moderate income households. I'll show you what low to moderate income means in just a second. Depending on what states you have as your, kind of your goal to purchase, those income limits will vary. When you get into California, for example, you can make in some programs up to 150% of the median income, where some states may say you only can make 80% of the median income to be eligible. So when we look at the Georgia program, there's a couple different assistance options. There's the standard $10,000 assistance. There's the standard $10,000 assistance program. There is a program for first responders, educators, up to 12,500. And then there's for some of our clients that are dealing with a disability, there's a $15,000 choice assistance program that can help. So depending on what purchase price you're trying to get to, it could cover the minimum down payment of 3% for a conventional loan or 3.5% for an FHA loan. So as you heard earlier, a first-time buyer is someone that hasn't owned in the past 3 years. And that's what you would need to be able to be kind of a participant in these programs. Now, there is income limits that are based upon the county that you're going to purchase in. So these are some of the counties across in the regions across Georgia. So depending on where you're at. So I know we have one of our students tonight from ATL. So those would be the low to moderate income levels that to have eligibility in the Georgia Department of Community Affairs program. Okay. Those income limits, like I said, look different for every state across the country. So we don't have time in tonight's class to go over each state's options, but for those of you looking to purchase in other states, like I know we are, just reach out to me after tonight's class and we can kind of talk through some of the programs, whether you're in Boston or California or Arizona, we can kind of talk through those different scenarios. Okay. Now, what's not totally different is the process or workflow when you think about home buying. So as you're considering taking the next steps towards homeownership, the workflow will generally look the same for whatever state you're going to purchase in. So let's kind of walk through what we call our 6 steps of home buying. The first step is going to be what we call as pre-approval. And pre-approval is going to be the output of what a consultation would be with us. You've heard me mention that a few times tonight, which is a consultation is a one-on-one session where we design a home buying plan. And then the pre-approval will come out of that consultation with us. A pre-approval is a certificate that you receive that you can present to a seller that says that you have your financing in place, right? The pre-approval is good for 60 days, but it can always be recertified at any time. So a lot of our buyers are not looking to go buy, get pre-approved today and I'm gonna buy a house next month. It doesn't always happen that way, especially for first-time buyers. It may be a 1, 2, 3 month process, or sometimes it's a multi-year process. So, we can always recertify that pre-approval at any time. And just as a reminder, it's just a soft credit check, so it doesn't impact your score to get that pre-approval. Now, step 2 is gonna be house hunting. And usually your house hunting will probably start with an online search. And then once you've kind of found places that fit your criteria, then you're probably going to go out and start looking at homes, right? And we would encourage you to connect with a realtor because realtors should be experts in their market. They're going to help you with negotiations, inspections, all the things that you need as a partner to help make sure that you're making a good, sound purchase decision. And so that'll be step 2. Now, if we fast forward to step 3, and let's say we've found a place that we really love, we submit an offer to the seller. The seller accepts that offer. And I have to forewarn you, probably not going to happen on offer 1. It might take to offer 2, 3, 4, 5. Sometimes it takes 10, 12 offers. But let's say we get lucky and the first offer we submit, the seller accepts that, right? Well, now we're going to move to step 3 in the process. And that means we have an agreed upon contract and we're going to open escrow, which open escrow means different things in different states. But ultimately, now we're going to start the processing of my loan. That processing usually takes about 30 days. So if we were to look back at this kind of graphic, right? So going from step 3 to the finish line is about 30 days. Now, sometimes it can be shortened, especially in a competitive market like this. We do offer a quick close program. It's not always suitable in every state that we operate in, but in California, for example, you could do a quick close where you can shrink that from 30 days down to 14 days to be able to purchase your home. And the advantage there is to be able to have a more competitive offer for a seller. But in this scenario that we're talking about in class is that we have an offer now that's accepted. Now, what are the next steps going to look like? Well, as soon as your offer is accepted, we'll reach out to you and first of all say congratulations, because that's kind of half of the battle is just getting an accepted offer. And then once we've done that, we'll explain to you next steps, which will include a follow-up consultation. So we've done an initial consultation for pre-approval, a follow-up consultation once your offer is accepted. And that's a video session we do to kind of talk through your financing, make sure you feel comfortable with, where the markets are at, what your numbers look like, and we'll explain to you a little bit more about the disclosure process. Now, within 2 to 3 days of the accepted offer, you're going to be required to make what we call an earnest money deposit. And it will vary depending on where you're going to buy in the country, but usually it's 1 to 2% of your sales price. Now that money is generally protected by what we call is a contingency period. And contingencies allow you as a buyer to do your homework on the property. Usually there's three kind of core contingencies. There's an appraisal contingency to make sure the house is worth what you're buying it for. There's an inspection contingency to get inspections done, like a house inspection, sewer, roof, pool, whatever you think you need to do. And then there's a loan contingency. That contingency period, and this varies for some states, can be in the first, 3/4 of the way of the process. So usually the first 14 to 17 days of the contract period. Okay. We would encourage you to have contingencies in your contract because then you add that extra layer of protection. So if you decide to cancel during your contingency, then you can get a full refund of your deposit. Now, I had a question in the chat, which is, what are typical realtor rates? Is it based upon the percentage of the purchase price? Are there costs usually from the seller? So that's kind of interesting you bring out that question because there was recently a ruling that came out that it changes a little bit of how buyers agents are paid. So when you think about purchasing a home, there's a buyer's agent that represents us, the buyer, right? There's a seller's agent that represents the seller. General rule of thumb 3 or 4 weeks ago was the seller always paid for the buyer and seller agent commissions, which can be anywhere between 2 to 3% of the sales price of the home. But there was a ruling recently that it's not a given that the seller has to pay for the buyer's agent representation. So that is on a transactional basis. It has to be negotiated in the contract. There is some kind of rebuttals going on with that, but generally speaking, the seller is paying for the buyer's agent as well as the seller's agent for the sale of the home. Okay. All right. Great question and a very timely question. Step 4 is going to be processing and underwriting of the loan. That's where we do all the administrative tasks of the financing. By this time, your loan is probably locked in with the interest rate. So we've got everything locked in. And why it's important to lock in your interest rate, because if you lock in a rate, let's say it's 7.1 today and rates go through the roof to 8%, you're protected against that, especially if you've already kind of thought about a budget at 7.1, rates go to 8%, you wouldn't want to have that exposure to a much higher monthly payment. Step 4 also has us submitting your information into an underwriter. So an underwriter actually reviews everything to make sure you fit all the criteria for the loan that you're selecting. That approval gets issued at step 5. It also brings us probably to the end of that contingency period that I just mentioned. At that stage, you can sign off on your contingency, and that tells the seller you're good to go because you've done all your homework on the property. We're also going to, as a lender, issue to you a closing disclosure. And that closing disclosure gives you a 3-day cooling off period to make sure you feel good about the financing and make sure there's nothing that's kind of changed that's not in line with what you expected before you go to the very final stage. And that's called closing your loan. And that's step 6. That's the very kind of end of the process. At that stage, you'll be signing final documents with a public notary or an attorney, depending on the state you're in. That process will take a little bit of about an hour or so. After you've done that, you'll wire in or give a cashier's check for your final funds to the escrow or attorney's office, and that money will get reconciled. And then as a lender, we'll wire in the funds for your financing. That money gets all settled up. You've contributed what you're supposed to as a buyer. Seller now knows they're receiving the proceeds that they expect. And then documents get recorded with a county recorder's office to transfer the ownership to you and record the deed, which is your agreement basically for your financing of your loan. And once we get confirmation that that's all done, then you can connect with your realtor and I get a chance to give you like my most important call, which is to tell you, hey, guess what? We did it. You're now the official owner of your home. And that's like probably the best part of my day because I get a chance to celebrate along with our new buyers, right? It doesn't come without, kind of a little bit of stress during the process. But we want to make sure that we're here to help support you. We have various means of communication, whether it's text, mobile, through our messaging system there, email, phone. Of course, we want to have every means to be able to stay connected with you because we understand, the concerns you might have during the process. Well, before we get to that step 6 in the process, the first step would be getting a chance to get connected with us for a consultation, like you've heard me mention before. So after attending tonight's class, if you want to kind of think about a home buying plan for yourself, whether it's, this year to buy, next year, maybe it's a 2025 goal, I would encourage you to get connected with us. It's a free service we provide for you. It starts with an online application, so we know a little bit more about you financially. You'll upload documents that'll be requested through the app. and then you'll schedule a video consultation with us. And that's about a 30-minute session. It's a one-on-one that you do with me. And I love getting a chance to get connected with our clients and helping kind of set some goals and objectives for homeownership. If you have some questions after tonight's class, and maybe maybe have questions on first-time buyer programs or a specific scenario, we can always set up a 10 to 15-minute call. You don't feel like you have to go down the consultation path yet if you just want to learn a little bit more. Here's what a consultation looks like. It's very similar to the things that we've kind of, in the concepts we've talked about tonight. So location of home, where do I want to buy? What's my budget look like? How do we, optimize our credit? What's our savings look like? Do assistance programs match up for me? And, we just want to kind of put a kind of all-inclusive program together for you that has some great goals and objectives for home ownership. You heard me mention our messaging system. That happens through our mobile app. You can actually start your application through mobile, available, of course, on Android and Apple. And the link for that mobile app is right there. You can also use the calculator function, which seems to be pretty useful for our clients. As I mentioned, as I launched into our class tonight, this is our very first Georgia Tech Homebuyer Workshop. I hope you've enjoyed tonight's content. If you have a friend, family, maybe a coworker that thinks hey, I'd really benefit from one of these classes, have them check out some of our upcoming classes. We still have a couple more left for the end of the year before we get to the holiday season. They can visit the class schedule at mortgageeducate.com. We have some other partnerships across the country that also support our communities in homeownership. If you want to get connected with me after tonight's class, here's all my contact information. You can email me, you can message me, whatever's good for you. We just want to be here as a support system for you in homeownership. And as I wrap in tonight's class, I would encourage you to check out what our clients are saying about us on our reviews. We're really proud about what we do for our clients in our community. And on our socials like Instagram, we're trying to put out useful content that can help support you on this journey, right? So you can follow us at JMeda Mortgage for more information on various first-time homebuyer programs. So with that said, I really do appreciate everyone spending this last hour with us. We're almost to the top of the hour. I try to squeeze in as much as possible. I'm going to open it again for any questions you have in the chat that we can talk through before we wrap up tonight's class. I know we're all in different time zones. Some of us are getting ready for dinner. Some of us are maybe getting ready to get off work. Some of us are, shutting it down for the night. So I'll go ahead and leave the lines open for any questions that you have and make sure that we get that for you. So question was, you can support anyone anywhere in the US, or would you be referring us to local? Actually, yes, we can support you anywhere across the country. So yeah, so we're a nationwide lender. And depending on which state, I do have partners internally that work in those states, but that's something we can talk about wherever you're at in the country. But yeah, absolutely. Okay. Any other questions? Appreciate you chiming in with some of those questions. And of course, if you have any questions that want to take offline, that's totally fine too. We just want to be here as a resource for you. Okay. I think we're good. I think some of us are exiting class now. So thank you so much again for attending tonight's class. I saw you in the chat, so we'll get you the scheduling stuff. I really appreciate your support in tonight's class. If you have any questions, feel free to reach out, and we'll be in touch for our next Georgia Tech workshop in 2024. Have a good night.